Good evening, everybody. How's everybody doing today? Welcome to Financial Independence Through Small Multifamily Investing. My name is Lawrence, Mr. International Laddie. I'm myself an investor also. I have 6 units here in the Bronx, New York, but I'm also looking in to scale up. So I'm looking in North Carolina, particularly the Piedmont Tri-area, Norfolk, Virginia, and also looking at Huntsville, Alabama. I am also a member of the GOB network and also a product of the Myers methods. So without further ado, we're going to bring on our guest speaker, Larry Pendleton from Norfolk, Virginia also, right? Larry's a CPA. He's been practicing for the last 8 years, and he's also an investor, right? Which makes a big difference because when you have a CPA who's also an investor, he knows the ins and outs, right? He's also a husband and a father of 2 lovely children. And his passion is helping other investors realize the gains to help them to make better tax decisions. And I like that t-shirt as usual again. Cash flow is my mantra. So go ahead, Larry, take it away. Thank you for coming.
Appreciate it, Lawrence. Always good catching up. Good evening, everyone. I think I've either met or seen a lot of faces up here. Aaron, of course, Nicole, Kenneth. I think we made a chat before on another meetup. Tiffany, good catching up again. Alicia, I was actually in Phoenix this past weekend for the Real Estate KI Knowledge Institution Conference. Fortunately, we couldn't link up. Thank you. But yeah, happy to be on. Happy to add value where I can. So hopefully I don't bore everybody to death with tax talk on a Tuesday evening. But it's important though, and I think we all know it's important because everybody typically are griping around 415 when they're finally getting their tax bill or they're trying to get taxes wrapped up. So I know the initial purpose of this meeting was year-end tax planning, and we're going in that direction. But I also wanted to focus more on just the missed opportunities that a lot of real estate investors are typically are overlooking, and that also can go into year-end planning as well. I am really big on interacting with everybody. So if you have a question, like raise your hand or yell at me or do whatever to just grab my attention because I can just keep going and freestyling this. I do have slides. Let me share this screen. And cool. Which page? Do y'all see the PowerPoint? Okay.
Yeah, well, we see common tax savings missed by real estate investors. Larry Pendleton.
All right, thank you. Just had to close an email and I had to wrap up a tax return before this, so tax season never ends. So we're going to jump into this. Like I said, just common mistakes, missed opportunities, and hopefully when you're meeting with your tax advisor, that this stuff is either being talked about or you're in a position where like you may have to. I know there's a lot of personal relationships when it comes to people's tax advisors, but it's stuff that like, okay, if you're not getting this information, you're missing out. You may need to kind of switch. I'm not trying to do self-serving for me. Like I honestly don't care who you go with as long as you're getting what's yours. That's what's important. So intro about me, born and raised in Norfolk, Virginia. I am an investor. If there's any jabs on this at me, it's because of my wife. But how I got started, and some people know this story already. I actually got into accounting with a crush on a high school teacher. That's not her, by the way, and my wife was not in the room. But so it all worked out though. And it's just kind of one of those things that I was just crazy enough to like accounting. But I also see my dad struggle with raising me by himself, and cash flow being always tight. So cash flow was always big for me, but then have a good year, and then April comes around and he has these huge tax bills, and then there's always a big gripe about it. So my passion for accounting itself kind of turned to how can I help serve as many people as possible. So my personal mission in life is to help as many people achieve financial freedom through real estate and taxes. Just based on how the system is built, like I said, unless we're going to tear the whole thing down, how this system is built, whoever is wealthy in this country, around the world, really, they are investing in real estate because people need a place to live, businesses need places to build at, so there's always going to be that advantage there. So, as mentioned, I am an investor. I currently have 52 doors across 10 buildings between Hampton Roads, Virginia, and Georgia. Always looking to expand. I'm actually about to drop down to 36 because we're actually selling one of our apartment buildings in Newport News. December 1st is the close date, so pushing that along. But I end up being a bit of a satellite investor. I'm not really married to any one group per se. It's whoever wants to bring me on. I'm always looking to network and partner with others and add value where I can. So disclaimer, all the good stuff, where this is only for informational purposes. Like, please consult with your own tax professional and your financial team in general, your attorneys, to validate anything that I'm saying. Like, some of the stuff that's may not apply to a lot of folks, and even if you have a question and I try to direct it towards you, like I haven't seen all your information to provide a full answer. I can only give general advice on these type of calls. So happy to dive deeper on if anybody wants a one-on-one call. You can scan this QR code here to get my contact information. Is also in the chat as well. So what we're going to go over is find the right tax advisor. Document. You can't say so much about how documentation goes a long way. Cost segregation, safe harbor, elections, and real estate professional status, which is always the hot button issue or topic that everybody wants to kind of address. So why is finding the right tax advisor is important as I see as a missed opportunity? And I'm choosing my words carefully because I don't really care if it's a CPA. I don't really care if it's an enrolled agent. It could be someone that works in H&R Block. Like, are you getting the proper advice of what you're doing? Because these 3 letters behind my name, I got that 8 years ago, and I'm proud of it. I worked my ass off for it, but it didn't teach me the knowledge that I have now about how real estate is very beneficial for people in taxes. So I don't get too caught up in it. Is just because I'm continually educating myself, and I don't even know where my CPA license is. It's somewhere in this house, and I probably should have it framed up. It's just not my style. But I also see tax advisors pretty similar to doctors, in the sense that if you are having a heart attack, you're not going to go see a dentist. So there's different doctors depending on what ailment that you need, or what you need to be seen, or what you can go to urgent care for and get an arm sling. Like, they're just going to send you to a specialist. So if you're not working with someone who specializes in what you're doing, especially on this call, if you're going to get into real estate, you may be missing out on stuff. And having the right tax advisor in your team helps uncover possible missed opportunities in previous tax returns, which I have seen before. The relationship is always going to be evolving. Pretty no different than your spouse or anyone that you're in a long-term relationship. Like, things change. Like, you were in single family, now you get into multifamily. Are those tax differences there? Like, what are those opportunities? You may be switching states. You may be wanting to sell your house, and how does all that work out? Like, I try to be friends with all my clients. I'm not saying that I am, but it comes with it, because you're allowing somebody into your financial bedroom, And so there's a lot of changes. Like it's only less than 1% of people in the world that knows what's going on with your financial, and your tax advisor should be one of them, so they can help advise so you can keep more of what you're making. I'm not saying there's nothing wrong with paying taxes, just you shouldn't be taxed on 30, 40, 50, 60% of your income. And then I won't say you get what you pay for, because you can really get expensive with when it comes to getting the tax advice and getting your tax returns prepared. You still have to find the right person, but it's all called with the due diligence and getting referrals and all that good stuff there. But that fee, whatever you're paying, is an investment. You just have to make sure you're making the right investment. Plus, it's a write-off, so it eventually comes back to you in one way or another. So, questions, comments, concerns? Should we keep rolling? We keep rolling. I'm getting nods from Janelle, so I'm gonna keep rolling. Document. There have been times where I have clients that have told me they spent such and such amount of money on such and such rehab. I don't have any documentation to prove it, and we have to leave it off. Making that say, or they just go away because I'm overly conservative. But I'm also a big dumb jock as well. I used to play football. I got the bad knees to prove it. I can't protect your blind side, i.e. your audit, if I don't have supporting documentation. Like, I need as many bullets I can possibly have, because it's not so much if you get audited or if you get a tax letter. It's really more of like you most likely will get one, because it's not unusual. So it's not about getting ready, just stay ready. Because what you have to remember is, all your working life, the IRS knew exactly what you have been making year after year. Your employer sends them a copy of your W-2. If you're self-employed, your client is sending a copy of the 1099, so they can get their write-off. So the IRS always known what you made. Now you switch into real estate, and there's no evidence of, no one's sending them, they're not getting third-party verification of your income, and then you're reporting all these expenses and all these deductions, and you got all these losses, and you're paying $750 in taxes like Trump, and you're a millionaire. So it's like, okay, what are you doing? What's going on? There's nothing wrong with that. They just want to check under the hood. That's all they're doing, just to check under the hood, just to see if you, because most people, there are people always take advantage of the system, and they should be punished. But we all doing the right thing. We all got our paperwork, so the burden of proof is on you. It's not on your tax advisor. They're only preparing based off of what you gave them. And I have clients that told me, like, I don't know where that number came from last year. That's what the person put in there. Like, did that person sign off on your tax return? They was like, no. So like, that's a red flag. They're not willing to sign off on your tax return, because I got signed off on too. I may not put too much credibility on these 3 letters, but I'm not about to put on the line for anybody. What I do for my dad? Nah, not even for him. He can go to jail by himself. Anyway, and another question I get a lot of time is receipts versus bank statements. And it's very, very important to know that the IRS prefers receipts and invoices, because that's coming from the source. Your bank statement isn't the source. Your bank statement is basically like a level down from that. Could you use it? Yes, but also keep in mind that your bank statements may not provide good descriptions of what the transaction was for. So you want to make sure that you're keeping those receipts and that they're showing the proper documentation. And I have the 5 P's, whether it's your meals, and you're going out on business dinners, and I can tell somebody like Robert like popping bottles. So like, just make sure that it's like, you got the price, the people that are involved, the purpose, place, and the period, i.e. date. I was trying to be clever. I couldn't think of another word for date, so I did went period. So excuse my corniness there. I saw somebody raise their hand. Was that you, Kenneth?
Yeah, I don't know if you're gonna cover this, but say, like, how deep do we go down on this? Because, like, say you have a professional property management, and he send you your year-end statement with, like, and repairs and maintenance is listed on as a line item, say a couple thousand for like a small apartment building. do you go to the property management company, say, well, I need invoices for all those, or if it's like, you know, for work that under a couple $100, they just take care of it. So how deep, if you have like I see bank statements, if you have a property manager, how deep do you still go do that?
That's a real good question. So that would be on the onus of the property management company, because they're providing you a month end, year end statement. They made payments on stuff, so like they're saying that all was paid already. So your support is the property management company because they made that payment, and per the agreement that you have with them, anything below whatever dollar figure, they can just go ahead and pay from that standpoint there. Yeah, missing back.
Thank you.
No problem. Great question. Thank you. Where were we? Receipts, invoices, and then leverage technology. Like, I mean, we're in the 21st century. Like, there's so many apps to help store documentation. Like, there's no reason to be keeping like if you come to me with a shoebox on receipts, we going outside. Like, I don't care where you are. Like, I'm gonna catch you outside because I am scarred from my dad. He's gonna be referenced a lot in this because I cut my teeth a lot with him. He still smokes cigarettes. He gives me a Walmart grocery bag full of receipts because he does HVAC work, and we butt heads a lot. So anyone else, like, we gonna fight. So use technology. Be kind to your tax advisor, and plus it's like, so you're going, like, these things, like, it's paper. It gets crumbled up. You're going to lose it. It's going to fade. So, because if you ever get a letter, if you ever get audited, it's never the next day or the next year of your taxes filed. It's going to be 4 years down the road. Or from that standpoint, there, it's always going to be some weird time frame that you wasn't expecting. It's like, that's from 7 years ago. Like, why are they pulling that? Now I gotta find this receipt that I stored in this file cabinet. And you probably good record, like, keeping good records, but, like, why not just maximize, like, what technology can do for you? And here, download the file, give it to the auditor, and tell them to kick rocks from there. And just and make sure that you're qualifying your business expenses. Like, just because everything is going through your business, like, you want to make sure that is locked down tight, is a business expense as much as possible. So I got the acronym of FREE, like, for business purposes. Obviously, like, it's a regular purchase. So if you got a short-term rental that you're constantly buying toilet paper, I got 4 of them. Actually, I got 5 of them now, and we're constantly buying just toiletries and all that. There is an essential need for your business. So replacing a roof obviously is an essential need for real estate, from that standpoint there. And is it economically priced? Like, is it like I said, especially if you're traveling now. If the best price, like, I'm 6'2", 275, so, like, I'm gonna pay for a little extra leg space. So it's economical for me to pay for that, so I'm not grumpy where I'm going. That doesn't mean you can't fly first class. It doesn't mean that. It doesn't mean you can't have a nice dinner, for a nice business dinner. It doesn't mean you can't like, splurge on different things. Or, I mean, you got one of the key strategies, especially for year end, is buying the vehicle. Everyone talking about buying the new G-Wagon or whatever. I know Nicole got that Tesla money, so she's probably getting something that's 6,000 pounds, so be able to write that off as well. So, like, it's economical for your business because you're trying to portray yourself, and you're using this vehicle to help build clients or meet clients and meet investors and all that, and you want to look good. So, quickly through that. Questions, comments, concerns?
I got is a lot of this stuff, or I don't know if you're going to talk about it at some point, for the real estate professional versus the W-2 employee. what are the differences of what we can write off? Like if I'm a W-2 employee, what are the differences that I can write off versus a real estate professional?
Are you talking about just in general or
Just all right. So I mean, you just talked about a car. I know you were joking about the Tesla, but
I
you
wasn't
know,
joking. I'm dead ass serious.
um, I guess are there any considerations that need to be made for a W-2 employee, especially if real estate does not exceed or make up a certain number of my income? Are those things still feasible? So maybe it's specific, but are
Well,
those things feasible for the W-2?
well,
Like the threat?
to dig deeper into your question is you have business owners in general and just W-2 employees, and part of the 2017 tax changes was that they eliminated unreimbursed job expenses. So the aspect of, hey, I gotta buy these certain clothes, or I gotta pay for this certification for my job, like you no longer are able to itemize that, which isn't that great of a thing, but that's neither here or there. So the aspect of being the business owner is, in general, is always going to allow you to have access to deductions, whether or not you're a real estate professional. It's just these are business deductions for your business, whether it was mileage, whether of certain equipment that you're bringing in, or materials for your business. Where for employees there's really nothing. As I tell people, the tax code, and I think some of us already know, is not made for the employee. It's made for business owners and investors, because all the government wants to do is just make laws and regulate them. They don't want to get into really infrastructure and providing housing and providing jobs, because a lot of times they're not really good at it, and there's a lot of evidence of that. So really, it's incentivizing people to do that. And part of that is being able to just write off a whole bunch of qualified business expenses. So hopefully that answers your question. We will get into real estate professional status. You're kind of jumping a bit on me, Tiffany, but it's all right. Anybody else? We're good.
Well, let me sort of jump in. Like, say I'm not a real estate professional, but I don't have a W-2. How much, like,
You got an hours question?
well, it's like how much, because I heard like if I go to conferences and stuff like that, I can't write that off my passive income. Is that true or not? Like if I have expenses, if I'm not a real estate professional, say I go to a boot camp, or I go travel to a conference, or I sign up for like a online course, but I'm not a real estate professional. I don't have the active real estate income. I have passive income. Can I write that stuff off?
Oh, y'all jumping ahead so y'all so eager. I love it.
Oh, if you're gonna cover it, just say, hey,
we're going to cover
hey,
it.
stand back.
I'm gonna get you, Kim. I'm gonna get you and Tiffany. I'm gonna get y'all straight. Don't worry.
Right.
We gonna get there. Because all of this is going to roll into real estate professional status, and part of it is cost segregation. And does anyone don't know what depreciation is? Let's just start with that. So we all on the same page. Everyone kind of get what depreciation is, which is one of the huge incentives to invest into real estate, because you're recovering the cost of the building over a certain period of time. And people hear about cost segregation, but what is it really? In the grand scheme of things, like there's different components of the building itself. Like people just say like, hey, you invest into this syndication, we're going to get a cost segregation, we're going to write off $3 million. And I've done it as well. I've done 2 syndications, and it's an incentive to get investors involved so they can get additional losses. The problem is, and we'll roll into that when we talk about real estate professional status later on, is that a lot of investors aren't real estate professionals, so they may be capped on how much of those losses they can take, because we're taking this building, and so we're breaking out the land, because you can't depreciate land, and there's you got personal property and you got land improvements that depreciate at a faster rate. than the whole building itself. So that's what the cost segregation is doing. Is in the word itself. Is segregating the cost of everything into its appropriate buckets. So now you got level 1 is just depreciation. Level 2 is the cost segregation, and then breaking things out into 5, 7, 15, 27 and a half year property, 39 year if you got commercial property and short-term rentals. And then level 1, 2, level 3 is then the bonus depreciation from the 2017 tax change, that anything depreciates less than 20 years, you can recognize all of that in year fully depreciate in year 1. That's the piece of it that these syndicators and everybody is really selling from that standpoint. That's how you get these huge losses with these apartment buildings and self-storage facilities and houses. I mean, you can do a single family house. I know people say if it's not at least $500,000, it's not worth it. Like that's BS. Like you can still have a good tax deduction off of that, and benefit from it more than what you paid for that report. And then asset disposition even goes even deeper, because if Jim bought a house and he has to depreciate the roof on the house as is, but that's all in that price of the building. But if he replaces the roof but doesn't remove the value of the old roof, he's depreciating 2 roofs, and that doesn't make sense. So now you got this additional value of this old roof, and now you're able to write that off now and have a huge loss to offset against possibly against other passive income, but quite possibly non-passive income as well. And before we get into questions, I like my Big Mac analogy, which just kind of straight line. I think Big Macs are worth $3.99. It's been a while. I've been trying to lose a lot of weight these past few years. But really, like the cost segregation, it takes that price of the building itself. So you got the whole 2 beef patties, special sauce, lettuce, cheese, pickles, onions, and the sesame seed bun. So they end up breaking all those pieces out. So depending on what you're looking at, those other items will be able to create these huge losses for you in year 1 of your tax return, and then whatever's left over from the building keeps rolling forward. So you never really lose depreciation. You just kind of accelerate more of it up front, and then as you continue to grow your portfolio, you're just compounding that on a year-to-year basis. I'm gonna pause. Questions on that? Did I lose everybody?
I have a question.
Go ahead.
So you completely lost me, but so I just purchased my property about a month ago. So then would I be able to use this process this year, or do I have to have it an entire year? How does that work?
So you can use it this year, because always depreciation is always factored in at the end of the year. So okay. I'm gonna provide a real live example for a property I've done here as well. I like my Big Mac analogy, but sometimes you just gotta go live. So at the end of the year, so even though you bought it now, or you bought it, you said last week or last month, congratulations.
Thank you.
So really, you'll at any point of the year, you can get this report done, and you can do it even after the tax, or you can do it after 2021, as long as it's done before your tax return is filed.
Got it.
So what we end up doing is, so the purchase price, the depreciable basis is this. It's $318,000, but the cost was really like closer to $400. But we had to break out the land portion, and you're not really going to see it up here because it's not important. It just kind of sits on your balance sheet. And then from there, based off of some questions and other stuff, we'll break out, okay, 5-year property is this much. I mean, it was a very small yard, or no yard at all. So $2 was calculated into there, and then the rest is just 27.5-year property. So now we're just saying with bonus depreciation, we're now showing an additional $64,000 of deductions in year one, and with this person with over 40%, like their tax rate was over 40%, like they're getting $25,000 of additional tax savings, which is huge from that standpoint. There, if you're just trying to wipe out other income from your other properties as well.
Okay.
Was this helpful at all, Tamika?
A little bit.
So Larry, could you give an example of, say for instance, you're a high income earner and you're earning 400K a year.
Mm.
And just for the sake of argument, let's say that you're paying 100,000 in taxes. And so in order to offset that 100,000, how much real estate would you need to buy using cost segregation and bonus depreciation in order to offset that $100,000?
So if you're a high income earner, and we could just, so if you're a high income earner, if you're making $400,000, it's honestly it's not going to matter if you do not, if your spouse is not involved in real estate and can claim real estate professional status. Because this is what all this is kind of leading up to, because the difference between, from an investment standpoint with real estate, is that aspect of you can claim larger losses against your income, active and passive. So, because the issue is that you have two buckets of activity: active and passive. So your active is your W-2, your business that you're actively involved in, stocks, and capital gains and interest there. But your rental real estate is what the IRS considers as passive, because people typically just buy. They think people just buying properties and throw property management in there and not really involved. They really don't know how detailed it is. So even though you can get a whole bunch of losses from depreciation or even from just your standard write-offs, you're not going to be able to offset that against your high income because of just certain limitations, because of those limitations between active and passive.
Right. So you're not going to be able to write them off unless your spouse. So really, because that's the purpose of. That's one of the reasons of being a real estate professional. The only reason it is that you're trying to unlock these passive losses to offset your non-passive activity. That's really the only reason to be a real estate professional. Because other than that, it comes with a lot of scrutiny because of how powerful this can be. And I know people kind of go through the rules, like yes, it's either you or your spouse, if you're married, 750 hours and more than half your work time to doing it. So if your spouse can get to that point, like great, like you all got this real property trader business. He or she is really involved, got the hours to prove it, tracking the hours as well. That's very key to remember in this point here. So you can have all these write-offs, and in some expenses you can just that doesn't mean they're not deductions. It just doesn't really serve a purpose if you're kind of putting in time. So more to like Ken's point of, I paid for this real estate conference. Like does those hours count towards real estate professional status? And it's like, no, you're not really running a business per se. Like anyone can just go to a conference, and that's not really actively involved with the business. You're just going somewhere, but that doesn't mean the cost that you incurred is not a business deduction. So there's different layers to it, and so it's very difficult for Jim. If you're trying to be real estate professional, it's difficult if you have a full-time job to prove that. Because we're talking about more than half your work time, and the average person is working 2,000 hours a year, roughly around that. For a full-time job, especially if you're netting that much from your W-2 or even from your business. But to sit there and tell the government that, like, yeah, I worked 2,000 hours at my job, but then I also worked 2001 in real estate, that's not going to really fly too well in court, per se.
Unless you have it documented.
There has not been a case yet that a full-time employee was able to prove real estate professional status. All the ones that have came across have been shot down in tax court.
So let me give you an example. There's lots of people that work much, much more than 2,000 hours a year. There's people that, especially poorer people, that have two jobs, hold down two full-time jobs. Very commonplace. Business owners that are used to working anywhere from 80 to 120 hours a week. So it's not unusual for people to have. I know it's a small percentage of the population, but there's lots of people that work much more than the 2,000 hours, which is a standard 40-hour work week, 52 weeks a year. And so with that said, you know, the status here is just working more than you do at another vocation. And so it seems, how do you determine of my two jobs, which one is my primary job?
Well, that's where I say the burden of proof is on you. So, like, the aspect of tracking not just your real estate hours, but also your W-2 hours as well, because like you it's me, you talking to me. I'm believe you. Like that's great, but you got these people over here that's gonna call BS, and they want to see how detailed that you are tracking. And it's like, okay, you working 40 hours a week, and then you're saying you also basically you're working 80 plus hours per week. And like I say, it's possible. It's just is to go through all of that and to be documenting your time. It like I say, it just not it has yet to be won in tax court yet. Like I said, that's why I just say it's difficult, not impossible, just very, very difficult. And you are talking about a small percentage of people in the world that are putting in that amount of time and can prove it from that standpoint there.
And ideally, everyone that's in this business, that's doing it actively, that's really pursuing it, even if you're working a full-time job, if you're pursuing this very, very, very hard, and you're working every spare hour that you have, weekends, and spending time that you could be with your family, and you're doing this, I think it's extremely important to give you the how can I versus don't try this. And I think that if you're married, you need to have your spouse, if you're not both working a full-time job, let's say your spouse is either stay at home or works a part-time job and only works 30 hours a week, anything that you can do to have one of you as a full-time real estate professional. And you do need to document. You need to have a calendar. You need to have a CRM. You need to be documenting every minute that you speak to someone about real estate, including if you're a doctor and you're sitting on your lunch break at the hospital and you're having a conversation on the phone with a real estate investor. You need to document that. You need to put it in your CRM. You need to put it in your calendar. You need to follow up with a phone record. You need to do whatever you need to do to cover your butt. You need to practice the diaper theory and make sure you cover your butt. But I'll still say that you need to find a way to be a professional, because if not, there's just huge advantages that you don't get to take if you're not a real estate professional.
I agree. Like I have no issues. It's just like I say, it's especially if for people who are just trying to dump it onto their spouse, and their spouse isn't involved in the real estate at all. Because what people don't realize is that part of the audit guide that the IRS uses, that they're going to interview. They're going to interview everybody that's involved. They're going to interview your spouse. So it's like, okay, you do need to make sure that your spouse is involved. If you're going to go down that route of like, I got I got this 6-figure whatever $250,000 job. Like, okay, spouse, like, all right, like, manage the rental properties, like get the hours, like do what you can to get involved with that. They may not be the only ones involved, but like it's definitely something to kind of keep in mind, if especially with a lot of people where there's 2 working parents in the house as well. So it's like, okay, even the 30 hours a week, you're still kind of pushed. As I say, I'm all ultra cautious of this, even though I recommend it a lot. It's just, can you do it? And I put up an example here of one of my clients, and it's like I look at it for myself. It was like, okay, this person is very thorough with what they're doing, and they're tracking. He's tracking his hours and his wife hours, like all the way through, because just for the material participation aspect of it. And we'll dive into that in a little bit. But I mean, because they're on the edge of like can they get it or not? Like, but like it's like it may be enough here for them to feel comfortable doing it. I also had clients where the husband is a contractor and the wife is the property manager. Like, done, like you like that's your jobs. Like, you get W-2s from it, you paying yourselves. Like, that's like there's very little tracking that they even have to do at that point, because they're doing that on a full-time basis all the time. There's no comparing, there's no trying to max out against or offset against W-2 income or non-real estate income as well. Like, their children are old enough to kind of like are out the house, so like they are full go with it. So there's examples of it. Like I said, there's one of the things where it's walking through, getting an understanding of, okay, what hours do qualify, what hours don't qualify. Like, you just looking at Zillow doesn't qualify. You just doing like paying the bills don't qualify. It doesn't mean you don't. Still, you try to track what you can, but if you're just barely making it over the qualified hours, you're going to lose those on the back end if you ever challenge in tax court.
Nicole has a question.
Oh, I was just about to say, oh, I got a question. Okay. So the only way that I've heard of trying, because I thought about this a lot, and I think we had a call about this, Larry, a while ago, when I was trying to figure out, all right, I'm tired of these passive loss limitations because I can't claim real estate professional status because of my full-time job, and what other ways are there around it? So I have heard about using short-term rentals as a strategy for being able to still claim all the losses that you incur. But now I have an additional question, because I know the IRS considers if your average stay is 7 days or less, that's considered short-term rental. So if you make sure your average stay of your short-term rental over the year, stop screaming, guys. If you make sure that your average stay over the year in your short-term rental is 7 days or less, and there's a lot of other qualifications you have to meet, just like real estate professional status, but that is the only other way that someone who has a full W-2 job could also, get those loss limitations kind of waived. But my question is, because short-term rental is considered active income, and it can be, all the losses can be set against your active W-2 income. But does that also mean now you can lump together all your losses, even if you have passive losses too, if you meet the losses for the short-term rental guidelines? So that's what, I don't know why I assumed that from the beginning, that like if you do that, if you meet the short-term rental regulations, now all your losses, passive and active, can be written off against your active W-2 income. Is that right? Or do they still have to be separate? Will you still have passive loss limitations on the passive side, but you can take all the active write-offs? I just wasn't sure about that. Thank you.
Yeah, so, and that actually, I had that down here for the short-term rental strategy. So thankful, because it goes into material participation. Because on top of real estate professional status, it means nothing if you're not materially participating in your own rental portfolio. And the hours are for real estate professional status and material participation is really the same, like property management, construction, deconstruction, those type of hours there. So the short-term rental strategy is saying that, okay, yes, 7 days or less, if you have multiple, whether it's but you're making this election that this is not, this is a rental property that is actually active, that doesn't bring in the other non the other long-term rental properties. You only are bringing in the losses from your short-term rental properties there.
Oh man, all right. Well, that's not the answer I wanted, but I guess that's the answer I needed to hear.
Yeah, I mean, it's like I say, it's great. And all like I say, sometimes it's having to be the bearer of bad news, but it's like it's what's needed to be heard at times, because people just, like, a lot of times just want to hear what they want to hear, and then they take all these losses. Like no, this is separate. Like, if we're going to make these elections, it starts to break away from other things there. Even for people who passively invest in deals, like, you cannot materially participate in a deal that you just are a LP on. It doesn't. You're not actively involved. You're not making any management decisions. You just attended a webinar and you get paid and you go from there. But there still doesn't mean there aren't advantages. I mean, it's still the aspect of, you can still increase the income in your rental real estate, where you really have to see it as tax advantage. You may not have the losses to offset your W-2, so you're still trying to grow this thing to potentially replace your W-2 income. Is that what you're looking for? But then you're actually able to accelerate your income with this avenue that's taxed less, because you're going to be writing off all these additional expenses, taking depreciation, and not being taxed on that income as well. And that may put you or your spouse, or if you're single, in a position of, okay, I don't need to work this. I may can downgrade, may not be able to leave your job completely, making either downgrade jobs and just work less, but start to still slowly put a strategy in place to get more and more passive from that standpoint there. Like, it's not all doom and gloom, because, like, I still got, like, we all got trapped into the matrix and got got W-2 jobs. And now it's like, okay, how do I offset this? And it's like, you really have to keep focused on driving up passive income, or income that's taxed less than W-2 income. And Tiffany, did I address your question as well in all these discussions? Is she still on?
I'm still here. Yes, I'm listening. I'm not married, so none of the spouse stuff applies to me, but I'm listening. Yeah, you're doing good. I'm good.
Yeah, I just want to make sure I answer your question. Even from someone that is single, like, I mean, you're still in that same situation.
Yeah.
That Nicole's talking about. That's why, like, real estate professional status is now a loophole. Depreciation is now a loophole. Cost segregation is now a loophole. The short-term rental strategy is a loophole. Like, do not be surprised in 2023 if they close that. Because it's a carve out. It was never meant to be a separate strategy that everybody started to rush into short-term rentals and mountain houses and log cabins and all that great stuff. Now, I mean, it's why we're doing it. Like, I'm taking those losses from those 5 rental properties, offsetting my tax business income, and rolling from there, and also my wife's W-2 and all that stuff. Like, I'm maxing out, because I know they're going to close that. Like, there's no loopholes in the IRS. There's very little loopholes in the IRS code. Everything is actually legit laws that people just complain about because they don't fully understand it. And then, Ken, did I address your question as well? Oh, he's gone. It's a nice chair, though.
Okay, listen, Larry, let me ask a question.
Mm-hmm.
So, the real estate professional status. So, I don't know. Am I jumping ahead? Or are you?
No. Let's go.
Let's go. So now that I'm retired, right? Can I now become a real estate professional?
You could, yes.
Okay.
So, like, I mean, you have the additional time. I mean, get off the beach and do some work and all that good stuff there. So you don't have to, like, you can just meet the bare minimum of 750 hours, and the 50% doesn't even matter, because you don't have a job to really balance it off against. But then you still have to materially participate with your own rental properties.
Okay. So let's say, for instance, like I went down to North Carolina to do a walkthrough inspection. On the walkthrough inspection, was that the airline flight and the time I spent at the hotel, the money I spent in food, is all that tax deductible also?
It's still tax deductible, and I think that's where Ken was going with. And I think Tiffany, I think you were trying to go down that path as well. As like, even though you like the flight down hours, that doesn't count, especially if you're just kind of doing a walk through the property and you didn't acquire it. So it's like, okay, those hours don't count to real estate professional because you don't really. I mean, unless you have a extensive portfolio and you're traveling around, like, okay, you can start to get some of those travel hours, but typically they've been striking down on the travel hours. It's definitely something that I recommended people. Like, if you're close and you have an extensive portfolio, then like I'm more comfortable with it, because like you have other properties there, you have another reason to be there. You're involved with the rehab, or you're meeting with the contractors and the property managers from that standpoint there. But just because the hours doesn't count for real estate professional staff, that doesn't mean the expenses that you incur are not business deductions. Those are still write-offs for the business. Now, depending on, now you may have an acquisition business in general where there's not really a property tied to it. So now you go from it being passive losses, a passive expense, more to your acquisition business expense, which then can, if that's showing up in a loss, then you're able to, because most likely you're just accumulating losses or expenses that are not associated with a property that you own. So, but the income that you're making with your real estate business is all in your rental properties. So now these expenses over here that you're incurring from traveling all over the place and looking at property that you don't close on, those can still now offset some of your W-2 income there. So it's still good to kind of track these expenses, even though they may not lead to securing your real estate professional status.
Thank you.
Gotcha. So should all expenses be incurred under an LLC, or can you still write off those expenses if they're under your personal name? So for example, I have two properties that are in my personal name, right? Mm-hmm. And then I hold assets in other LLCs. But if I incur expenses just under my personal name, how would I then write those off? Do I need to assign or allocate them to a business?
Nope.
Okay.
LLCs do nothing regarding taxes, or they do nothing regarding the write-off of expenses on your taxes. They're one step into a bigger tax play that has nothing to do with your expenses, and they're really more for asset protection. Because really, you got to think about it, that your LLC is a disregarded pass-through entity, which means that you is it and it is you. Even though there's an EIN number, like, you're reporting all the activity on your personal tax return. So, and that's the case. If you didn't have it, you would have been doing the exact same thing, because you're running a business with your rental properties.
Thank you, Larry.
Gotcha.
Yeah, I think people get caught up in, like, do I need to put my property in the LLC and all that stuff, and it's like I mean, I don't really care. Like you don't have to, but you should, from an asset protection. If I'm talking investor to investor, like, yes, but I can't speak on the legal aspect of it. Like, you should be doing it from there. But I know that you're going to get a loan easier under your personal name, especially if you're just starting, or you just got a few properties. Like, you're going to have to get in your personal name. You're going to get a better rate until you have a large enough portfolio, and then you deed it over to your LLC from an asset protection purposes. And people get caught up in, like, oh, the whole due on sale clause, but it's all, unless you're deeding over to a LLC and a partnership, like it's still all just you. And worst case scenario, if the bank ever finds out, because you shouldn't be telling them anyway, you just deed it back over.
Mm-hmm.
It's none of the bank's business what you do with the deed. They have already sold your loan 5 times.
Mm.
And didn't tell you anything about it. You just got 5 1098s for no reason. You don't even know who those banks are.
Mm.
I digress though. Any other real estate professional status questions?
None.
Okay, I see you answering some questions, Nicole. Nicole trying to take my job. But yeah, so hopefully, like I said, real good questions, real good concepts from everybody. Definitely appreciate all the feedback. But like, yes, the main thing, if you're going to go this route of real estate professional status and material participation, like tracking your hours. That's why I brought up. Can y'all see this spreadsheet? Like, so this is just, I mean, like I said,
Larry, can't see the spreadsheet. You gotta go out. You gotta go out of this screen to go to that spreadsheet. Stop sharing and go back into that screen you want to share.
Oh, like that. Well, that sucks. Thought I had it all figured out. Thing about being self-employed, you gotta be your own IT person for the time being.
There you go.
Is it coming up now?
Mm-hmm. Right.
Yeah, so this is just one example of a real estate time tracker that I worked with a client with, and I just kind of took out the names and properties, but yeah, you just kind of go through it. Same thing, like just very detailed, different guidance. So we have another version that we use as well. Just reminders of just kind of what to look for, and I say he has a lot of updating to do, but yeah, and how you do it and how frequently you do it, like you really just have to find what works from you from that standpoint there. I thought that was worth sharing. Okay, cut this thing back on. So that was kind of, let me get back to the presentation. Okay, there we go.
Are there any easier ways to track your time? Because that just seemed like a lot. And I know I heard about some apps or something, time tracking apps, or I need something easier than that.
Yeah,
I would never do it.
I forgot. There's one called RE Tracker. There's an app. But I think there's a fee for that. I mean, I know some people just use their calendars and just keep updating their calendars from that standpoint. There, like it's a tedious, annoying process. Like I am not going to sugarcoat that at all, and it's on purpose because IRS, like they're trying to prevent people from easily abusing that benefit, because it's real easy to. And that's why, like I said, especially if you're like single with a job, like it's like I can't get around it. That's why everyone is flooding towards the short-term rentals and just and just capping on that until they close that window.
You can't get to the slide.
Oh, I was just talking, chatting, and answering questions. Boom. Okay. So yeah, Big Mac analogy. We did all that stuff. Safe harbor elections are really big for investors, especially when it comes to rehab costs. Like depreciation is good, but it's not great. Primarily because we're trying to recognize as many expenses now as we want. Like if you had the opportunity to just write off the whole building, you're going to write off the whole building. But you can't do that. So the same thing goes with repair costs. If you're not mindful of how your renovations are being invoiced and itemized on those invoices, you just can't give me a $15,000 invoice to repair a kitchen and expect me to expense all that. Like depending on if we're just talking about it's like just one house and we're doing like, because I don't know what that consists of. That may be components in there that have to be depreciated. So the tangible property regulations, like it provides the guidance of what can be expense and what has to be depreciated. Because it sucks because with repair costs, there's no loan from that. Like with the building, you pay 20% down, you got this nice loan on the property. Those repair costs, those are all cash out of pocket year one. And if your contractor is just giving you just a flat straight invoice of everything done, like there's so many times I'm looking at people's tax returns and they just have building improvements or as a depreciable line item. And it's like if you just got it broken out, you could have expensed some of that. And as I mentioned before, like we're trying to do multiple things. There's a benefit to it. One, like I say, we're recognizing more expenses now. Two, depreciation itself is just an interest-free loan from the government. Because if you ever sell the property, it's called depreciation recapture, and you have to pay all that depreciation back. So we want to limit how much depreciation that we're taking as much as we can. We want to max it out. But we can move it from being in a depreciation bucket to just the expense bucket. That year goes by and it's gone. You sell the property 15 years from now, and now you have reduced your capital gains by just doing that type of tax planning up front. So like it's very, very, very critical to that you can do it like materials versus labor. Have a detailed breakdown. Like I have a lot of contractors who don't like me now because I have I have preached this to my clients, and like they are now going back and say, can you break this number out? Tell me everything that you did. What was the material? What was the cost of the labor? And give that to me in 2 separate invoices. You're the customer, and it's like it sucks to have to go back and do it. It's one of the things now that you probably want to start having those conversations up front with your contractors and your handyman. And this is kind of a brief example. This is the one I actually did for the 16 unit in Newport News, where there's certain items like the new siding for $11,000. Like, okay, we can't really break that out into anything else, materials with that much. But then the windows, $10,000 for material, $8,700 for the actual labor. But because they put 50 windows, we can save. We can apply the minimum safe harbor regulations, and just say anything less than $2,500 can be just expense, no questions asked. 10,000 divided by 50 is obviously less than $2,500 per window. So now we're able to take $18,000 of expenses and write that off. So that's how we was able to take this $125,000 in total rehab costs and write off $88,000 in 2020, because having to go through this and getting cussed out by the contractor. It was like, we can do so, I can go somebody else, but we're going to get this done because we ain't had to do the cost segregation. We saved the money on the cost segregation by doing this, and we can now double up on the cost segregation in year 2 if we wanted to, and provide double the amount of losses for our investors in back-to-back years. A little bit in the weeds there, but once again, questions, comments, concerns.
Yeah, if you don't
Yeah.
do it the first year, is it over? Too late?
It's not too late. You can always amend previous year's tax returns, or if it's old enough, you can file a form 3115. You're just having to, because depending on what numbers that you're working with, you're probably working with current year numbers, but then having to do some type of present value analysis to determine what was the value of that. Like, we spent $10,000 of windows in 2020, but we're in 2025. What would have been, like, if you have it broken out like this already? Okay, you may not have it already, but you can go back and amend it, or go back and change it, and just kind of do that assessment there. So it's not too late. It's just like, is it worth the time and the money to squeeze that juice out, because you're going to make that money back and then some with the corrections that were made.
Question, Larry.
Oh.
Go. Question. What's the difference between repairs and capital expenses?
Like, repairs are something where it's expected to be replaced on an annual basis, or it's regular maintenance or regular changes on it, on their like, replacing the roof isn't something that you're going to change on a regular basis. That's where we kind of get back into our, what's a business expense, and if it's for regular use. From examples, so like replacing the actual the roof itself, or just repairing shingles, are two different things. So you kind of go into what's the extent of the repairs that are being done, and if it's going to be something that is materially affecting the whole building, because you can go some years with some messed up shingles. If you just got a straight up hole in the roof, we gotta get this whole roof replaced. From that standpoint, so that's where you kind of get into those differences there.
So, like, this year, I had to replace the whole roof, right?
Mm-hmm.
Replace from top, from side to side, right? Replace the whole roof. So would that be a capital expense?
That would be a capital expense,
right? That'd be depreciated over X amount of years.
Yes, 27.5 for a roof.
Now, would it make sense in that case that they broke it out between the labor and like the material for the roof replacement? So you're replacing a whole new roof or that, and take 10,000 labor, 10,000 for the materials, 20,000 for the roof. Do you have to do 20,000 depreciation, or can you break it out between 10 and 10, like you did the siding, and say expense 10 and then depreciate 10? That makes sense.
Well, for the siding, we just had to depreciate all of it. So once you break it out between materials and labor, and you can't justify, because there's other tests, whether there's a betterment, adaptation, and restoration to the building itself. So it kind of goes to it could have been more detailed. Like, we replaced all the siding in the building. Like, that is materially affecting the whole building. Like, the cost is there, so we just got it broken out labor material. So, but still, $23,000 was depreciated from that perspective. If we were just replacing, we just got to replace this one side of siding over multiples. Like I said, we can probably start to justify that we didn't make a material change to the whole building and be able to expense that. It's no different than, you had to replace the whole roof, but let's just say we're talking about a 1,000-unit apartment building, and there's multiple buildings, and they're all components. You may have just replaced the roof on one, but they're all kind of attached together, or you just replace a segment of that roof, but not the whole thing. But how much of it? Like, was it? And typically, the rough estimate is like if it's 30% or less of the whole building, then you can somewhat start to justify being able to expense it. There's no tax law that really documents that, or tax code. It's just kind of just been a rule of thumb from just talking with other CPAs and IRS agents when it comes to what's a reasonable amount if you're not doing a full replacement of something. It's no different than because another example up here is our HVAC units. So we did 5, but there was 16 different HVAC units. So we're in the position of that's not a material number of units of HVAC units for a 16 unit apartment building. So we was able to expense that.
So a quick question now, right? Going back to HVAC unit. So if you replaced 9 of the HVAC units, therefore you can break it down the way you have it now.
Yeah, we're saying 9, but then even though it be
It's still the
yeah,
same thing.
so now we're getting more into like because can you have a building without the HVAC units, and it's like no, so like then we're getting into okay, we could probably
Right.
fall in the safe harbor from that standpoint there. There'll be some cheap units though. you got a price like that in New York.
No, that ain't happening. Thank you, Larry.
Thank you. Great questions. Really great questions. Anything else?
I don't see nothing in the chat.
But that's really it. I mean, it's really more now of like, okay, we kind of went into some more of the heavy hitter type of stuff. So, I mean, for me now, for a lot of people, it's really like meet with some professionals, the right professionals from a tax advisory, even from a legal perspective as well. If you're looking to get more LLC set up for your properties because you may or may not need them, put that plan in place and then execute and then reassess from there. Because that kind of goes with the evolving with your tax advisor. Because what people typically assume is that, hey, I got this person, they know what they're doing. All right, I'm gonna get all these losses in year 1, and then somebody like Nicole just found out like, okay, I can't get these write-offs because I still got this job. So like, I'm actually at the same place, so me I have to be paying more because I thought I was going to get these things, and come to find out I can't. But like now you're with somebody now that can help put a plan in place. Like, okay, what is your future goal? Like, do you love your job that you're going to be there forever? If not, what, like, hey, when do you see yourself getting out? Okay, can you claim those professional status? Then like how to actually acquire more properties, and once again focus on generating income that's not going to be taxed, or not taxed as heavily as your W-2 income. So even though you made money on it, okay, great, you can reinvest that into other properties or to keep that cash flow growing, so that you can once again replace your W-2 income and have the choice of whether or not to work at your job. And I know some people like to do the Grant Cardone method and claim 20 kids or whatever and get no taxes taken out, like, which is a great strategy to do. Just make sure you're going to buy a property from that standpoint there. Is even from a strategy aspect of, do you 1031 versus doing a cost segregation? Like, okay, it's great that you 1031, you offset the gains, but you're just kicking that can down the road. Where like cost segregation, you just using the losses from the new property to offset the gains possibly from the old property. And then that's all part of just putting these separate plans in place and just not jumping into something that may not be beneficial for you. You know, like ending off with this quote from Jim Rohn, because I mean, at the end of the day, I know everyone kind of mentioned what they do, but like I'm more of a cash flow. I'm a time and cash flow investor. My time is more important than anything. So if I can find different ways to maximize it, I'm gonna go ahead and do so. I imagine everyone else is someone in that same boat of not wanting to have their time spent in places they don't want to be at. Unless you like your job, then have at it.
I like my job. I love my job.
There you go. But you left. Congratulations.
Thank you, brother.
But I appreciate all this. This has been great. I love the questions. I love the interaction of this because, like I said, it keeps me on my toes, and to make sure I'm providing additional value. So, like, this is what I basically do all this for, is for these knuckleheads here. But like, happy to answer any of the questions. My contact information is on this QR code. Please reach out if you want to talk further. And thank you again.
Thank you, Larry. Thank you very much. Thank you. Very informative. I've heard you talk before, but this is different. Like, this is different. This is you went down and got dirty here today. I appreciate that. Thank you very much. I'm sure. I'm hoping, but then again, I'm sure that everybody got some value out of this today, right? And now that we know, we also know now that Nicole has money for a Tesla. I didn't know that before. You know.
Yeah, I'm trying to get $5. That's all I want. $5.
Y'all are really funny. Oh man.
Well, listen again, Larry, thank you for your time. Really appreciate it. This is great. Thank you very much. So before we go on a break, I don't know if everybody go or stay. But before we go, I take a picture. I didn't take a picture last week, which was shocking. I forgot. Right? I messed up last week. I had to take a picture. So I'm asking you, please come out of your hiding state, right? Please take a picture with us. Thank you, Gordon. Aaron, are you there, Aaron? You're busy? Ray, you there, Ray? Still having problems, Ray? Ovi, Terry?
Yeah.
Okay, can you come on camera, please? Thank you, Terry.
Hey, Lawrence, I'm in my car, man.
Okay, you still driving? Man, listen,
So.
don't put your camera on, bro.
You can give us a nice shot of the highway.
Stay focused. Stay focused, okay?
Look at the camera too.
Good camera, right? All right, everybody on count of three. Come on, Kevin. Thank you, Kevin. Everybody, 1, 2. I'm waiting for Robert to finish tea. Get Robert. Everybody smile. 1, 2, 3. One more time. Everybody say Tesla.
Tesla.
Thank you.
Nicole, can you get me that S-Class? I want the S-Class.
Oh no, I know nothing about Tesla. That's not even my dream car.
Aaron's already going, Nicole, Miss Tesla Pendergrass. I think that's
Oh my gosh, Aaron is doing that because he loves nicknames.
Once again, Larry, we want to say thank you again, Larry, for coming. All right. And I don't know if you'll be able to stay or not, right? For breakout room or 2. Right? Is it possible? You staying?
A little bit.
Okay, great.